Hi, I'm Alex Mozed, founder and CEO of Applico, co-author of Modern Monopolies, and we are here today on Winner Take All to talk about all things tech. As everyone knows, the Dow has and the S&P 500 have both passed their all-time high thresholds. The S&P 500 passed the 3,000 mark for the first time ever. The Dow's over 27,000, and the markets are just on fire, largely because the economy is strong. And the Fed has now signaled that they may be cutting interest rates, or certainly not raising interest rates, but they may also be cutting interest rates. The way that this rolls into the tech world and the platform world is debt has been relatively cheap for a long time. And the fact that debt could now continue to be cheap, if not cheaper, obviously helps the equities markets, the stock market. Where this is a problem is that there are a lot of businesses, like in retail, which have a lot of dead weight. And if we look at the amount of debt that has been issued over the past 5 to 10 years, there has been maybe a 70% increase in debt from private companies, roughly. If you look at the amount of earnings increase over that same period of time, the earnings are maybe 30 to 40%. There's a large delta here where the amount of earnings and increase in profitability, there's actually a big delta in that being able to pay for all the increased amount of debt. That's a problem. And that's one of the symptoms of when the interest rates are so low. So what industries are being propped up that probably should have had this debt default or roll over or go into bankruptcy? Retail would be one of those. Yesterday, we were talking a lot about Amazon and their dominance. And there are so many different segments of the retail industry that should be bankrupt right now, or should not be able to take out debt, or should be paying for debt that's actually much more expensive. And that's unfortunate because it enables this dead weight to stick around in the economy, as opposed to the healthier businesses surviving and the less healthy businesses needing to be put into restructuring or something like that. So I think this is becoming a problem. Winner-take-all markets in retail with platform and tech monopolies like Amazon are definitely helping to accelerate things. But the fact that cheap debt is continuing to stick around is actually arbitrarily extending the timeline for a lot of these businesses. I'm not going to let that book fall. So to kind of continue on this trend, let's bring in my co-author, Nick Johnson. And what we're seeing is basically the trend with all these retailers 20 plus years too late, except for Walmart, because we like Walmart and we think that they're doing it much better than everyone else. But it's kind of like everyone and your mother as a retailer is now launching a marketplace. Who was it that just, Nick, you were telling me before this that just launched a marketplace that just went bankrupt?
Toys R Us. So Toys R Us went bankrupt, and I think part of their restructuring plan is basically let's do a marketplace, which is basically throw a bunch of third-party products on top of traditional toys. But I would be skeptical that they're actually going to embrace a real marketplace model there.
Right. So this is the trend, right? Like my core retail business is not good, and I should have innovated a long time ago, but I didn't. Okay, fine. But now let's do a marketplace, and bam, magic! Like we are now this cool new innovative company.
Yeah, the problem is that when they say they're doing a marketplace, in most cases it actually means let's go get a handful of partners and sell a few complementary products on our website via drop shipping. It's a very far cry from what you've seen actual marketplace businesses or big marketplace companies like Amazon doing in retail.
Right. So we've got J.Crew launches a third-party marketplace. Target announces a third-party marketplace called Target Plus. Best Buy in Canada has a marketplace. Urban Outfitters has a marketplace. I don't know. There's probably some others. Albertsons in the UK has a marketplace. Everyone has a marketplace, apparently. Why aren't these things marketplaces?
Well, the challenge, and you see this with a lot of large enterprises that are trying to figure out how do you deal with Amazon, is they take a top-down approach. This is actually what Walmart did initially when they launched the Walmart Marketplace. They called it the Walmart Marketplace in 2009 when they launched it. It was really Walmart and 3 partners when they first launched it. After about 5 years, it was thousands of products at a time or tens of thousands of products when a time when Amazon was selling millions of products and SKUs. And they really didn't embrace this marketplace model. They said, oh, let's add a handful of people. It's really more of a extended partnership model than a true marketplace where you're actually inviting third parties in to sell. And you see this with, J. Crew. You've seen this with Albertsons. A lot of these companies, Target, we're right. We call it a curated marketplace or something to that effect. It's really just a new model for partnerships to allow other people to sell on your website and drop ship. You extend your range a little bit, but you're really talking about thousands or tens of thousands of SKUs when consumers expect a lot more than that. And that's not really delivering them the real value of a marketplace.
So let's say someone opened it up. Even if here's my problem with it is, okay, they may say it's curated. I think they're saying it's curated because they know that if they did open it up, it wouldn't really no one would join it. I think that's the real problem. They're saying it's curated and we're doing partnerships because no one cares. No one wants to join. If I'm a third-party seller, why am I going to go sell on J. Crew, Target, Best Buy, Urban Outfitters, Toys R Us? I'm not going to do it. I'm going to sell on Amazon. I might consider selling on Walmart. Maybe Alibaba, I don't know. But I'm not selling on. So how do you solve for the scenario where if they said we're going to open this up, we want everyone, we want not just manufacturers, because I think a lot of these people are trying to sell to brands and manufacturers, but I want the third-party sellers. I want the millions of third-party sellers and distributors that are then selling, essentially reselling onto an Amazon. How do I get those people? And I think the challenge is that they don't have enough demand. Whether it's a Target down to a J. Crew, down to an Urban Outfitters, you just don't have enough demand that's going to incentivize a third-party seller to go create an account, to go and do all of your fulfillment protocols and all these kinds of things. There's just not a big enough carrot. So you're kind of stuck in this chicken and egg problem. So what do you do?
I actually think there are third-party sellers that would want a sell on these websites, just not the ones that they're targeting. So the typical approach, again, is this top-down, let's go get other big brands and bring them in as, quote-unquote, marketplace partners. There are a lot of small sellers and third-party sellers out there that would love to sell on a J. Crew or a Target. But that's not who they're targeting, and they don't take this bottom-up approach, which if you're actually going to build this thing successfully, is what you need. And that's what Amazon did very well initially. They had a bottom-up approach. They had lots of very small sellers, and that's part of what drove that success. Now, if you just start with the big guys and start to work top-down, you're never going to get scale.
Yeah, but hold on. I don't understand why they would want to sell if you can show them demand. I don't think there's enough demand on these places' e-commerce sites to say, look, I have limited time and resources. Why am I going to go dedicate my time and resources on this new fledgling initiative rather than try and optimize on Amazon? I think when it comes down to the numbers just aren't there.
I think it depends on the scale that third party is expecting. I think if you have a really small retailer, someone who's a small, for example, fashion company that is looking for something that's more curated and actually targets a particular kind of customer, J. Crew might be interesting to them. But for the most part, J. Crew isn't targeting that kind of seller to sell on their third-party marketplace because they have, I would assume, concerns about brand and, what do we, quality, and do we invite these third parties in? They haven't really embraced this marketplace approach and actually opened up to actually get the kinds of sellers that could actually build something that would then bring them more demand and it could help them get the bigger guys.
I don't think you just open it up and they come. This isn't a build it and they come thing.
Right.
But this is where I have a challenge with it. I think these guys need to hack. I think these guys need to fake it. I think these guys need to put supply onto their site that doesn't exist and show that if we add hundreds of thousands of SKUs or focus on specific areas, right? Something's got to come first. What's the chicken and egg here? And I don't think them just saying, hey, come sell with us is going to be enough of an incentive. I think you got to start bringing deals, bringing business to the third-party sellers. And you kind of need to scrape Amazon, copy Amazon's inventory, copy Walmart's, go copy other people's inventory and say, what am I missing here? And I don't think I can go recruit all these third-party sellers to come because they don't have any faith in me. And why are they going to take all the time to list all this inventory and do all the pricing and do all the logistics when I'm not going to give them guarantees that they're going to sell a certain amount of business because I don't even know. I think these guys are stuck where they don't have enough leverage to get these people interested. and they're not going to take enough risk to try to prove that there is demand, which means you got to seed the marketplace with supply. I think they're stuck where they can't get supply to prove that there's demand, and they can't get demand without showing that there's supply. And I don't think that any of these companies are really going to figure this out until they get some brand separation and start to take some risks, because it's not going to work. Right? What I'm saying, if you go list 10,000 fake products on your website that you don't actually have in your warehouse, okay, some of those deliveries aren't going to work. But the point is that you have given Amazon a 20 plus year head start, and you've got to cut some corners. Because if you just try to do this in the lines, it's not going to work. And I don't think it's working for any of them.
I think the funny example of that company that actually did try to compete with is Amazon, Jet.com. They did that. That's exactly what they did when they first launched their website. They put a bunch of products on Jet that they didn't have third-party sellers signed up for. And then if someone bought the item, they either took it to the third-party seller and said, hey, you want to fill this? Or they just went and bought the item from the third-party seller and then shipped it to the customer.
Yep. I would go get an army of people in India doing offshore work and like fulfill this. And if I have to go get 1,000 people doing fulfillment and buying this stuff off of Amazon and it coming in an Amazon package, I'm just riffing here, but what they're doing is not going to work unless they start cutting some corners.
Right. So I think you can get some of these small guys. I think it's not enough to get the kind of scale you need, particularly in retail, where you have a huge competitor like Amazon, to go and get it. So yes, absolutely, you have to fake it. And you've seen Jet do this, and that was part of how they got that initial traction. You can't have enough product breadth that people are expecting in retail just by getting a handful of small guys. Mm-hmm. You can fake it and then start to bring some of the other guys in as you actually show them, hey, I've sold a bunch of your products.
I've sold your
stuff.
Come
list on my website.
I'm giving you business. Now come. Very different model going to third-party sellers, where now you say, look, I've already given you business. I just want you to help me help you. Right? Give me some more inventory and I'll give you a self-service tool. Right? Now you post it. But I don't think anyone's just saying, yeah, okay, let's do this. Okay. In other news, we had Amazon just announced that they are moving into the professional beauty supply space. Beauty unveils a beauty store for professionals. This is a big deal for companies like L'Oreal, all of the companies that have beauty products. Basically, they had all of these B2B supply chains to retailers and to the spas and the places the salons, right? And they would have these B2B sales channels that they've had for many, many years. And now Amazon's coming after that. And I think Lady Gaga just announced that she is picking Amazon for a major beauty launch. I mean, beauty is something we've looked at where it's sleepy, it's heavily fragmented. There's, I think, over 50% of this of like the makeup and beauty supplies that people are buying are actually from startups. Yep. Many of them launching directly onto Amazon. And now I think one of the last areas of the kingdom for the L'Oreals of the world was their B2B supply chain to the spas, to the salons. And now Amazon's going after that. I mean, this seems like very bad news for the beauty CPG companies.
Yeah, if you talk to them, even a year or two ago in some of these companies, which I have, a lot of them didn't think Amazon could do this. Oh, people won't buy these things online. I think
the stores, the salons,
particularly the B2B customers, but also the retail customers. And I think you're going to start to see that change, and they're going to have to change their tune and react to this. Because Amazon, I think, to be fair, Amazon is still very early on in this. You go and look at their website. I saw an article of someone looking at, Amazon's in beauty. How good is that buying experience? You try to buy certain kinds of cosmetics, it's very hard to find them because they don't have the filters and things you'd normally find on, say, a Sephora website or others that actually help you to find the products you're looking for. Mm-hmm. So they have a long way to go still. But if we've seen anything in other industries, they couldn't sell fashion before that. They couldn't sell TVs. Mm-hmm. They couldn't do B2B. They'll figure it out. They've got the scale, they've got the consumer demand, they have people selling these products, and they're going to figure it out, and the beauty industry is going to have to figure out how to deal with that.
Yep. So let's talk about some antitrust stuff that's in the news. And, I think everyone, maybe it was a couple months ago, where Elizabeth Warren came out with her plan about, needing to break up the tech giants. This was actually back in March, like Amazon and Facebook and all these kinds of things. There's a lot of hoopla around people like Lena Khan saying that the University of Chicago antitrust theory is wrong, and that antitrust precedent needs to change, right? And our point of view on this is these people are all wrong. These people don't really understand platforms in the sense that the key crux of the platform model is I have a consumer and I have a producer. And when you think about both of these user groups as customers, obviously a consumer is a customer. But now let's think about Amazon. Who's Amazon's customer? Where do they really make money? They really make money from the third-party seller, right? When I buy something on the Amazon marketplace, Amazon charges a maybe 10 to 20% fee to the third-party seller. And the third-party seller is effectively paying Amazon a commission, a take rate. Same thing on YouTube, right? YouTube takes a 45% cut from the content creator and then pays that fee onto YouTube. And you have the same model play itself out, whether it's across other marketplaces, other content platforms. Think about the Apple App Store, right? Where actually Apple got in trouble with this with the Supreme Court, but really wasn't that big of a deal. Where it's really the third-party developer paying a 30% fee to Apple. So if you think about the producer as a customer, and that these platforms really have two customer groups that they're serving, the antitrust precedent for the past 50 years has said this: you are considered a monopoly that's breaking antitrust law if you take advantage of the customer. And what's the litmus test to take advantage of the customer? It's whether or not you are raising the price on the customer. Now, historically, we've always looked at the consumer to say, are you raising the prices on the consumer? We saw this with Standard Oil. We saw this with train companies, right? Taking advantage of the consumer and raising prices.
AT&T.
But now, the argument that people are trying to make to say that they're violating antitrust law is that privacy has a cost to it. And because these companies are taking advantage of your privacy, there's a cost. Here's the problem. Do that cost value analysis, right? Every platform is either free or much cheaper than the alternative. So now I take free or cheaper, and then all the value that comes from that, whether that's Google search, whether that's YouTube, whether that's Amazon, fill in the blank, Facebook. And then you say, how much is the cost, the penalty to the consumer for them to, by the way, voluntarily use these services? And then does the consumer come out ahead or not? We'll be in court for 10 to 20 years, and you'll find that, yeah, most likely the consumer wins. The consumer pretty much always wins. That's the whole value prop of platforms. The consumer wins. That's why they are so dominant. When you run that analysis on the producer and you say, does Amazon raise prices on their third-party sellers? They absolutely do. Whether it's the holiday season and now they're jacking up the take rate, or the
fulfillment
costs, rental fees, or now the holiday season is over and they jack up the rental fees even more to keep your inventory in the warehouse because they want you to clear out the inventory from the warehouse, and then you have to pay for those fulfillment fees to ship your product back to yourself, or whether it's the YouTubes and the content platforms and the social media companies of the world demonetizing you off the platform or banning you or taking down your content. This is all a form of putting the producer at a disadvantage. And there's absolutely a case to be made here that you could say, do the platforms, especially when they vertically integrate, right? When we saw now Google basically copy Yelp's content.
I mean, they've gotten into this with Google Shopping too, and other companies getting mad at them for diverting that. Or they've also gotten into it with news websites, and they have snippets and these things they've been doing now. TripAdvisor?
Yelp and TripAdvisor, both the CEOs came out and to say, hey, we support the DOJ looking into Google. And because Yelp has been basically suing Google for over 6-7 years now. And they are not only taking their content, but then what Google is doing is changing their algorithm and favoring Google's own local content over Yelp's.
Right.
And that is effectively raising the price because now you're forcing Yelp or TripAdvisor to buy ads on Google to still be relevant. It's just another way to raise price. So we've seen this, as you were saying, where the EU clamped down on Google in 2017, which is Google Shopping and making their Android apps get preferential treatment with the OEMs. Spotify sued Apple a few months ago for competing unfairly with Apple Music. Microsoft versus Netscape in the 90s. Whenever the platforms vertically integrate and now start to more aggressively compete with their supply, which are the producers, that is where they start to get into trouble. There's absolutely an antitrust case here that could be made and won that platforms raise prices on producers. The problem is it's not sexy. It's like the 1% of the 1% of the population, right? How many third-party sellers are on Amazon? A couple million. How many creators are on YouTube and Twitter and different content, a website, Yelp and TripAdvisor on Google. It's a much smaller portion of the population. It's not what's in vogue with privacy is horrible and all these kinds of things.
I think that also it comes down to who's reporting this. The media is familiar with advertising models, so they focus on things they're competing with, Google and Facebook, which leads to, I think, a red herring focus on, free products are taking advantage of us. And you miss the producer dynamic that you're describing, which is happening on Google. It's happening on Amazon, which isn't a free product. It's happening on all of these platforms where you have this producer-consumer dynamic, both customer groups. The producer is often the one that gets squeezed. If you just focused on, these things shouldn't be free and they should pay consumers, you're really missing the boat.
Mm-hmm. Now, here's a good thing. Well, the good thing, I think, for Google and Apple is the DOJ is reviewing Google and Apple. And from what I've heard, my people, is that the DOJ is firmly looking at this on the consumer side, the privacy side. Basically means DOJ is not going to get any wins. The FTC, from what I've heard, which is looking at Amazon, is much more willing. It also has previously stated an interest in protecting small businesses. So all the FTC needs to do is make a connection that small businesses are also a customer group. And the past 50 years of antitrust all fits. It all works. You don't need to rejig antitrust precedent. And, I'll be retired by the time the antitrust precedent is revised to actually classify these tech monopolies as monopolies. They're monopolies.
You can make a case that, we need to rejig antitrust law. But I think your point is it's not going to be effective in actually dealing with any of the problems and antitrust problems we have today because you have to establish the case law and all the things behind that. That's going to take years and potentially decades to get there versus how do we figure out how to make the status quo actually work for you by understanding how these business models actually work, that they have multiple customer groups.
Mm-hmm. Exactly. So, we'll continue to cover this and see what the developments are in this. And maybe we'll have some guest speakers on who maybe take opposing points of view on this. But the last note on this is that the privacy stuff, not only is it not going to hurt the tech monopolies, it actually helps the tech monopolies. Everyone rah, rah, rah about privacy. Let's look at GDPR. GDPR in Europe created all these rules and penalties and then fines if you don't comply with the rules about how to digitally advertise to people, to consumers in Europe. Guess who has the best technology and the best data to comply with GDPR? Google and Facebook. Guess who has a larger share of digital advertising post GDPR in Europe? Google and Facebook. So Google and Facebook should be kissing the feet of the European legislators for GDPR because it actually just wipes out all of Google and Facebook's smaller competition because now there's such additional overhead to comply with these laws and actually just consolidates the ad money to the large tech monopolies and creates barriers.
Right. So I think there's actually been studies done looking at how Google and Facebook complied with the GDPR. And basically they have the teams of lawyers and tech people. They find slick ways around this. The people that get hurt are the startups that don't have that. And then all of a sudden, my whole email list is dead because I have to get everyone to re-opt in.
Just, I think this is like a day ago. British Airways and Marriott are fined hundreds of millions of dollars for violating GDPR. I mean, when you think about why GDPR came into existence, was it because British Airways and Marriott were just so egregious in how they were doing their marketing in Europe that like these are really bad actors? We've got to protect the European consumer because, man, these companies are just malicious in their marketing. No,
it was all aimed at Google and Facebook, and Google and Facebook has figured out how to comply, and other people are struggling with it.
Yep. And that's the lesson for today, which is the legislation will never get it right. The only way to properly have some semblance of regulation on tech monopolies is regulation, not legislation. Anytime Congress or the European legislative tries to create a law, it won't work. Our US Congress doesn't understand the internet, let alone platform business models. So they need to focus on empowering regulators like the FTC to provide very bespoke regulation for each tech monopoly, because an Amazon is very different than a Google or a Facebook. And so it really needs to be specific to the company. And what you're saying is this one company is a monopoly and they're so large, there now needs to be oversight. And that is entirely appropriate because at the boundaries, at the extremes, there's absolutely cases of these large tech monopolies taking advantage of producers. And it's really not even Jeff Bezos who's saying, oh, let's really drive our producers into the ground. This is a systemic issue inside of large tech monopolies at the really mid to upper level management tier, where you are now empowering product managers who own a P&L, a product manager at Amazon that owns a P&L on clothes hangers is what we've kind of talked about, right? The product manager owns a P&L on clothes hangers. And then the product manager can say, hey, all of the third-party sellers selling on my clothes hanger vertical, hey, I need to view your POs. And they can issue these requests to the third-party sellers and say, let me see the POs that you have for the product you're selling on clothes hangers. And those POs list who the manufacturer is. I guarantee you, if the FTC asks to see emails from the product managers, they would see that the product managers are catfishing. Is that the right word? They're catfishing the third-party sellers. They're saying, show me the PO. And then the product manager is calling up the manufacturer directly and saying, hey, fulfill this directly with me. And they cut out the third-party seller. There are lines here where there's what's appropriate and fair in promoting fair competition and just taking advantage of your producers.
I don't know if that's catfishing, but it's definitely not playing fair.
Thank you. And on that, it's a wrap for Winner Take All. Have a great weekend, everyone.